Well, there you go, team. Good to see you. Morning. A little bit of a dropout, in and out. Alison, great to see everyone. Yeah, got some connection challenges with a few of the channels, but good to see those who made it are here. Good to see everyone this morning. Thanks for the shout out last night's session, Alison. Yeah. Absolutely. Scott's a bit of an amazing guy, and we only grabbed him for a short spot, so we might do something a little bit more in depth later on next year, which is kind of cool. So hey, good morning, Sean, Stephen, Alison, Chris, Bob, Jay. Might only be a few of us this morning. A little bit of dropping in and dropping out, and I've only got 2 or 3 of my channels going. So hopefully. We can upload this a bit later on, but hopefully you're all well. Anyone new? If you're new, there's my name, Jason Witten. Been doing these Wealth Coffee Chats for a while now, and in property investing over 20 years, coaching property investors with my team, Sam and the team across Australia and New Zealand for over 20 years. So yeah, and done a few deals. And each morning, get together with you guys and have a cup of coffee. We call it a Wealth Coffee Chat, and see if we can't keep an eye on this thing called property investing and how we can, excuse me, how can we can go the distance in this thing that we're doing called property investing, making sure we hang in there. And today I wanted to talk about the idea, the thought, because sometimes some of us can be misunderstand the marketplace and what goes on. The real estate marketplace going up. We're all happy if you're in the money, you're on a deal right now. You're happy. You've got a little bit of market momentum in your favor, which is fabulous, putting a bit of, equity in your pocket, so to speak. But that's not always the case. This is quite a unique moment in time. It's certainly one that we would always expect as a property investor. So let's talk about that today. Let's talk about, can property prices go down? Everyone's talking about property prices going up. Yes, can property prices go down? And yes, they can, and yes, they do. How often is that? Interesting conversation. I've got some stats here, and it's not all linear, by the way, so we'll chat about that in a second. The diversification process, diversifying our property portfolio, is important to understand that. So we'll dive into that this morning and spend our time with our Wealth Coffee Chat talking about that stuff. Quick shout out to Kev. Mate, good morning to you and Ingrid. Good to see you guys jumping on. And anyone else who's out there, give us a shout out in the chat. If you're new, say good day. So let's do this. All right. The idea of property investing is that over time, over a longish period of time, we want our properties to increase in value. That's a given. We're all like, yes, come on, let's get this puppy, this show on the road. We want property prices to increase. Fabulous. That's wonderful. The other thing that I think, you guys know this from me, it's actually quite important for our rents to go up. So we want our values to go up, and we want our rents to go up. And over time, we get some tax efficiency, from the properties that we own. But have a check out of this chart here, and this is some interesting conversations about some data that I just gathered from one of my good buddies, Timmy Boyle. Bit of a shout out to you if you're online. Thanks for always providing good data and good info. And so over the past 41 years, so that's a long time, 41 years. Oh, that's not going to work. Over 41 years, let's have a look at the periods of negative growth on a property market value. So Can property prices go down? And usually, team, property prices have some retraction after significant ups. All right, let me hear you. Let me say this out loud. Listen to me when I pay attention right now. You might even want to take some notes. Property prices historically and usually have some retraction from soon after significant increases. So what would we expect sometime in the future? What would be normal? Thinking about Scott Harris's normal, abnormal problem, a problem you just, an abnormal problem is a problem you just haven't seen yet, okay? What is a normal problem / normal part of the marketplace? Yeah, absolutely, Alison. What's normal? What should we expect at some point in the next 3 to 5 years? Put it in the chat if you want to get involved. We should expect a retraction from the highs of property prices, okay? That's coming. That's normal. That's going to be there, okay? So let's have a look at this. And this is kind of like, I wanted to do some sort of like, what's normal in this bloody thing, all right? So if we have a look from, 1980, I'm going to put my glasses on these days. Yeah, there you go. Aging, hey? Well, eyes, I don't know. What can you do for eyes? So, if you have a look over here in this section, okay, so from 1980 to 88, we had a slow but steady march upwards. And then what happened with the property prices afterwards? What happened, team? They went down as you go. Steve. Yeah, okay. Steve, do me a favor and send an email to either me or one of the coaches. We need your email address just to check it out, Steve. We can help you out with that, mate. So look at that, team. We had an upward trajectory for 8 years, and we had a downward trajectory, I don't know, looks like for 2 years, okay? So yeah, property prices can go down, okay? But did those property prices, did they retract to where, let's zoom in, did they retract from the starting point back to the starting point? No, all right? So what we saw is this kind of switch over here in this sort of section, kind of a 1 year period where you could kind of maybe get yourself a little bit caught, all right? If you bought at the high, you look like you have to be in this section here for 6 or 7 years before your values potentially get sorted again, okay? Everyone following along, hopefully this is making sense, all right? Let's dive in. So, again, another climb, and this is Sydney. I'm just doing Sydney for an example, and Brizzy and the other places have some similar profiles. Another climb, and then what's that, 96 to sort of 2003, okay? That's another 4, 3, 7, 8 years, right? And then again, we get this kind of down there from here, a 2 to 3 year period, okay? And we go to downwards again, okay? We got this sort of flattish period here. This time, you don't have to wait so long. That's not that long, maybe 3 or 4 years. And we get this significant up here for a while in Sydney, which came to around about here, and that was the APRA malarkey. We had some downs, probably the sharpest down we had in a long time in this marketplace, and now we're getting, boom, another bit of up, okay? So that's a pretty sharp upward trend. And, at the end of the day, will it sustain itself forever and a day? No, absolutely not. I reckon we got another year or two in some momentum in this marketplace in one way, shape, or form, folks. That's what I think. That's what's going to go on. But how do we manage these ups and downs? All right, so let's just quickly have a look before I move on and just do the diversification thing here. Sydney, over 41 years, 9 negative years. 9 years where property prices went backwards. Average loss per year, 5% on those negative 9. Melbourne, 6 years that property prices went backwards over 41 years. Brisbane, 3 years where property prices went backwards. Average loss, 3%. Melbourne, average loss, 4%. And then, the average growth rate over those periods between sort of 7 and 8%. So, at the end of the day, the future is not going to exactly mimic the past. However, when you see this kind of pattern where we get some upwards trajectory for a little while, and then there is an overshooting, the prices overshoot themselves, team. They overshoot the ability to borrow. They overshoot the ability to lend. They overshoot the ability to pay for a mortgage, whatever it is. Because the market's big at moments, and then it retracts for a little bit for whatever reason. Mostly and usually either to do with some political bloody stupidity or some banking restrictions because they don't know how to manage themselves very well. So how do we manage? How do we manage our portfolios into the future so we're not sort of, Jekyll and Hyde on this thing? Always, like when it comes to the world of property investing. And there's a couple of concepts. Well, there's one concept that you probably hear about it all the time. Diversification. I don't know. I think I spelt it in the, I think there's another I in there somewhere. Diversification. We diversify, okay? And how do we diversify as property investors? And there's a few smart ways to do that. Number one smart way, in Australia anyway. Now, you guys always make fun of me when I do this, but there it is. That is a picture of Australia, by the way. Now, I know my drawing is not great, but there you go, all right? But you get the picture. Hopefully you get the picture. All right. So for me and you, diversifying is pretty important when it comes to these ups and downs in marketplaces for a number of reasons, right? Number one, get rid of that. Number one, you want to have different growth cycles in your portfolio. Growth cycles, okay? Because, if you own every property in one location, yes, maybe the good time Charlies are getting growth in one area, but maybe in another state, you might not be, okay? So the idea, growth cycles across different states at different times, often for different economic reasons, pretty important, okay? Number two, the idea that we get some tax management, okay? Management. So, for example, land tax. Land tax is state-based, okay? Land tax goes all around Australia in different states. Also, different states have different stamp duty laws. Some of them try to do exit tax. I don't know if anyone remembers the exit tax in New South Wales. They put another tax on top of capital gains tax to then, so when you exit, you have to pay some more money. Like, it was like ludicrous, all right, as we go. And last but not least, price point, okay? Because, it'd be great. It'd be great to buy in Sydney right now, but maybe that's out of your budget. Maybe that's out of your budget range when it comes to you and your property portfolio and your diversification, okay? Away we go. So, different states at different times. We like the idea of at least 3 states to invest in, okay? 3 states to invest in. 3 states, 3 different economies, 3 different political exposures, and that gives a bit more diversification. So number 1, 3 states. We'll do this. 3 states to diversify into, okay? 3 states, okay? And we'll come back to number 2 in a minute. Okay. What's another way to diversify? Put it in the chat for me right now. We can diversify in different locations around Australia. There are 2 more diversification strategies when it comes to residential real estate. I'm not talking about commercial, retail, industrial, anything like that, team. So put it in the chat for me right now. What is another way to diversify? There's 2 more diversification strategies. And while you guys are maybe putting something in the chat, I'm going to draw myself a little kind of drawing, hoping that I can do it accurately. So what is another way to diversify? There's 2 more when it comes to your real estate investment portfolio. Let's have a bit of a look at this. These rings, yep, different types of properties. Absolutely, Stephen. The type. Okay, the type. So we've got number 1, the type of property, and number 2, okay, and Sam mentioned it last night at Mentoring Team, is the diversification of location within a city, okay, and then sort of unit, townhouse, apartment kind of goes along with that diversification process, okay. We'll squidge this up a little bit so we can see that whole thing. So the type of property and the location, okay? Now, the location equals, let's call this the inner ring, the in, the mid, and the outer, okay? The inner ring, the middle, and the outer, okay? And when we think about that, we think about what can across the rings. Absolutely, Stephen. Yep, you got it, man. Now, if we look at our ability to invest in our buying price and our buying power, now if you could borrow and buy, $1 million real estate, sometimes these conversations aren't as linear. But if your budget is constrained anywhere from sort of your buying power, kind of like 600 to 700 at the moment, that's the kind of price range you're getting, really good quality stuff, and you're still able to, buy well in this conversation. Then what are we doing? Okay, we diversify across the rings and different types of properties. Okay, so the inner ring, for most of us in this buying power or budget range, we're going to get a unit. Okay, so you got a unit in the inner ring. You'd probably get a townhouse in the middle ring, and you'd get a house in the outer ring. Everyone cool with that? Yeah? Now, that's depending on where you are right now. Let's use 2 cities for an example. Let's use 3 cities because we saw them before. Let's use Sydney. If we looked at unit for $600,000 or $700,000, we're talking 20K, 40K, and then sort of 100K from the city or this premium infrastructure location for those price points. And maybe 120, you're going all the way to Newcastle or even the Hunter Valley out of Sydney, okay? Now, if we have a quick look at somewhere like Melbourne, okay, if we have a look at Melbourne, is that any better? Now, you can get the unit for 600 or 700. You can still get inner ring, proper inner ring, really good inner ring properties in Melbourne, 600 to 700 in the unit apartment. So that Sam and I and the team, we still think Melbourne's got some amazing value. We think Sydney's bolted. And then townhouse, you're still looking 20 to 30K for the townhouse. But there is also a couple of opportunities in the house market that kind of, 25 to 40K out of Melbourne. So when we look at the Melbourne market, we're like, Melbourne market's pretty nice. We're still getting some good buying in Melbourne for the inner ring, outer ring, and that sort of stuff. And Brisbane, absolutely, you can get inner ring buying in like super awesome quality. And for example, inner ring buying in Brisbane for 600 or 700, you're getting really good 2-bed and sometimes even 3-bed inner ring apartments, compared to Melbourne, where you won't get a 3-bed for 700. Not a chance on the planet. And then, you're looking at the townhouse. You can still get that townhouse maybe from, it's not really 10 kilometres anymore. It's like 15 to 20 because that market's moved a little bit. So, you go 15 to 20, and then you get the house market sort of 20 to 30, okay? So when we're looking at a diversification team, we've got those 3 things, all right? So hopefully everyone's sort of chipping along there or following along. We've got those 3 things. We're going to diversify by state. We're going to diversify by type of property, and we're going to diversify by the rings, the inner, middle, and outer rings as we go. So for all of us, if we think about our portfolio, that makes sense, right? That makes sense. Now, you might have a house or 2 already in your portfolio, and I urge you to consider a different style of investment. You might, like one of my clients, he really gets that inner city. He's a young 30-something professional. He doesn't understand why someone would buy a house 30 kilometres from the CBD and waste their life driving to and from work. He doesn't get it. It doesn't even come into his head, right? So he has invested in quite a lot of apartments. Now I'm saying to him, we need to buy you a house. We need to get you a house. And I have these opposite conversations with people sometimes. Listen, you got too many houses too far from any decent infrastructure. Let's get you an apartment or a townhouse. But there you go, folks. Hopefully that made sense. Did that make sense today? Give me a shout out in the chat if it did. There is, for all of us, over our 15 or 20 year period, there will be times, probably multiple times, our properties will receive negative market growth, at least 2 to 3 times. Over that period of times, we will get at least 2 to 3 significant up spikes in our growth. And then the rest of the time will be pretty boring, either flat or just chipping away 2, 3, 4% a year. Nothing to write home about, okay? So for all of us, nice, Stephen. Good to see. Good job, Alison. So there you go. Diversifying, keeping it safe, not misunderstanding property markets. When we have significant upsides, they overshoot, they do correct. Usually 1 to 2 years of adjustment. Not significant, not the end of the world, by the way, folks. And if you've got excellent, amazing properties, then that's not going to be a problem. They receive less adjustment as we go along. Anyway, there you go. That's normal. It's a normal problem. It's just abnormal because you haven't seen it yet. It's normal because I've seen it literally hundreds of times. Anyway, there you go. I'm rabbiting on. 8:30. We should be done and dusted. Wealth Coffee Chat over and out. I'll try and fix my tech. I still can't see some of my channels connecting here today. So, but good to see everyone online, and join me tomorrow for another Wealth Coffee Chat. You guys stay safe, be well wherever you are, and until then, bye for now.